Thank you. Well, thank you very much, Ken. Thank you, everyone. After that, I may want one of those union cards as well. Be happy to join. I'll tell you, knowing my daughters, they will be signing those cards. So I look forward to it. But thank you all for this invitation, for receiving me today. I'm looking forward to hearing your questions and participating in a lunch with the senior executive. It's an honor to be here with Buzz Hargrove. It's an honor to be here with Jim Stanford, Ken Giorgetti, the other leaders of Canadian union movement that have done so much for this country and for working men and women. And Ken, I want to thank you for this invitation. You called me. I remember last November or December. You said that you were going to write to me and make sure that you'd get at least a couple of years as CAW national president without having to face another world crisis.
Thank you.
Yeah. And I thought the least I could do is to show up and discuss how we're trying to fulfill such an entirely reasonable request. And I'm grateful that you're still a young man because with a long career ahead of you, because it's a big mountain to climb. And I'm going to spend part of this speech talking about what we're doing on financial reform and then the balance of it talking about what's going on in Canadian labor markets, global labor markets, and the Canadian economy. La crise financière mondiale a eu un effet dévastateur. À la suite de l'effondrement de Lehman Brothers, le commerce international a reculé de 10% et la production industrielle de 18%. La production manufacturière canadienne a chuté d'environ 20%, tandis que la production automobile a plongé de 70%. Il y a eu 28 millions d'emplois perdus à l'échelle du globe, dont 430 000 au Canada, au plus fort de la crise. Les membres de votre syndicat ont été très durement touchés et les vagues de choc se font encore sentir. The financial crisis and the ensuing global recession demonstrated the fundamental interconnectedness of the global economy. Now, when that interconnectedness is built on bedrock, those connections of trade and investment create jobs and prosperity, including the $400 billion in goods exports and industries represented by your members. However, when those interconnections are built on sand, as was the case for much of the financial activity pre the failure of Lehman Brothers, the global economy can transmit instability, uncertainty, and unemployment. And I want to discuss today what we can do to build the foundations for the right kind of globalization so that you can concentrate on creating prosperity for your families and for fellow Canadians. Now, some of this is the direct responsibility of central banks. Some is the work of international policymakers at something called the Financial Stability Board that I head. And some is your responsibility to continue to help grow flexible, productive companies that can succeed in a fiercely competitive global marketplace. Let me start with what policymakers can do to ensure that businesses can get the capital they need to invest and to hire, and further, so that we do not experience another sudden shock here in Canada from events abroad. Achieving a stronger global banking system is the overriding priority. This means more capital, plain and simple. Before the crisis, international banks operated with $50 of assets, think loans, for every dollar of capital, 50-to-1 ratio. With only a 2% decline in the value of their assets, the banks saw their capital wiped out. And that wasn't far off, Ken, from your description of having no money in the vault to back up their loans. So in response, international regulators have increased the minimum amount of capital 5 times, and they're making the largest, most complex institutions hold even more. In addition, we've added a safety belt imported from Canada that worked for Canada, which is a simple but very effective leverage standard. And this is something that protects the systems from risks that we think are low, but in fact are not. Now, these measures, adding a lot more capital to the banking system, and the banking system is on track to raise that capital. These measures are going to lower the probability of banks failing, but since failures will still happen, their impact must be reduced. And that's one of the reasons why we are absolutely focused on ending too big to fail. We must address once and for all the unfairness of a system that privatizes gains and socializes losses, the sort of heads I win, tails you lose mentality. By restoring capitalism to the capitalists, Discipline in the system will increase, and with time, systemic risk will be reduced. In addition, the knowledge that major firms in markets far away from Canada can fail without meaningful consequences for us here at home will restore confidence in an open global system and allow Ken and all of us to focus on our day jobs. To ensure that bondholders, shareholders, and management, rather than taxpayers and workers, bear the brunt of losses in the financial system, all FSB member countries, including Canada, have committed to have in place bail-in authority and will have specific plans by the end of this year to recover or, if necessary, resolve each of these banks. Now, another important element of ending too big to fail is to ensure that key markets can withstand the failure of firms, and that wasn't the case during the crisis. We have to create continuously open core markets by changing the plumbing of derivative and so-called repo markets and improving data and having better tracking of exposures. The final element of international reform is working to strengthen the oversight and regulation of the so-called shadow banking sector. Think hedge funds, money market funds, securitization. The point is to make this a source of competition for the banks and diversity for the system, and that diversity brings resilience to the system. This will require changes to how money market funds are managed, changes to the terms of securitization, and most importantly, changes to the links between the regulated banking sector and these firms. And I want to give an example, a Canadian example of why this is important. In the summer of 2007, there was an obscure corner of the financial markets called the Canadian non-bank asset-backed commercial paper market. It froze in the summer of 2007. There were many consequences of that, but one of the consequences was that the auto leasing disappeared overnight. Prior to this point, and you'd know, 40% of cars in Canada were sold on lease. Now, we were fortunate in that Canadian banks were able to step into the breach, and this helped ensure that Canadian auto demand dramatically outperformed that in the United States. But relying solely on the banks is not a long-term solution. It's not a smart thing to do. And what we need to do now is to rebuild securitization so that Canadian consumers have low-cost financial alternatives, and so that if the banks have trouble, there'll be an alternative for Canadians to continue to purchase, and we're working on that as we speak. All of those reforms, those four big classes of reforms I referenced, they'll make a huge difference, in our opinion, if they're implemented. Canada learned during the last crisis that having our own house in order isn't enough. We need others to raise their game, and that's why the Financial Stability Board is increasingly focused on timely and consistent implementation of those reforms. We'll identify those who drag their feet or bend the rules to their advantage, and will hold them publicly to account. And that means we will report directly to the leaders of the G20 and simultaneously through the media and through our website to all of you who's doing what, who's ahead, who's behind, and who is, as I say, who's changed the reforms for their benefit. Now let me turn to developments in the labor markets. Workers did feel the brunt of the global financial crisis. In the context of a severe financial crisis, Canada's labor market has performed relatively well, both in absolute terms and relative to other advanced economies. I think you're aware that all the jobs lost in the recession have been recovered and a further 300,000 have been created. Now, since the trough of the recession, the vast majority of these jobs have been full-time and in the private sector, and nearly all the new jobs created are in industries that pay above average wage. While our unemployment rate has not yet returned to its pre-crisis low, this is in part because the working-age population has continued to grow and potential workers have continued to look for work. And this stands in stark contrast to the situation in the States, where a large number of workers have become discouraged and left the labor market. Over 40% of unemployed in the U.S. are long-term unemployed, compared with 18% of Canada's unemployed. The U.S. unemployment rate is a percentage point higher than ours, and it's 2 percentage points higher if you measure them on a like-for-like basis. But while Canada's labor market has performed better than most other G7 economies, we all know there is still slack in the market. We all know that it's not yet good enough. Our participation rate has not fully recovered, and the percentage of involuntary part-time workers has risen about 5 percentage points, and we just heard an illustration of that before I stood up. In addition, wage growth has been moderate and is expected to remain so. And this is one reason why monetary policy has been so exceptionally accommodative for so long. Interest rates have been at or near historic lows since the crisis began. Adjusted for inflation, the policy real interest rate has been negative on average since the end of 2008. And with a well-functioning financial system, something that distinguishes Canada, this means that the Bank of Canada has been able to provide exceptional policy stimulus to our economy, consistent with growing activity and employment and consistent with achieving our inflation target. Now, any analysis of recent employment performance should consider the broader context of an evolving workplace in a global economy. First, the share of employment in manufacturing has steadily declined across advanced economies, falling from 25% to 14% in the 3 decades leading up to the crisis. Even in Germany, the manufacturing powerhouse, the share of employment in manufacturing fell from 32% of total workers to 19% over this period. And in this context, Canada's record is about average, with a decline from 18% 3 decades ago to just above 10% today. Now, in part, this reflects the substitution of capital for labor. It also reflects the changing nature of globalization. In both goods and services, the current wave of globalization is transforming the nature of production and the demand for labor. In the first wave of globalization around the turn of the last century, the combination of sharp falls in transportation costs and large economies of scale in factories promoted the concentration of production and substantial manufacturing employment. In the current wave of globalization, which began in the mid-1980s, huge advances in communications and computing technologies have dramatically lowered the cost of coordination across stages of production. And this has promoted the distribution of these stages to the most cost-effective locations. One consequence has been a shift of fabrication jobs to low-wage locations in emerging markets. Even in services, complex tasks such as professional and health services are now being separated into their higher value-added and routine components, leading to outsourcing and job displacement. With companies increasingly part of global supply chains, competitive advantage will increasingly be concentrated in stages of production, such as engineering, design, or manufacturing, rather than specific sectors. In general, these trends mean that the demand for unskilled workers in advanced economies is falling relative to that for skilled workers. Some estimates show that by the end of this decade, there will be a shortfall of 18 million skilled workers and a surplus of 35 million unskilled workers across the advanced economies. These broad shifts in demand for and the supply of labor are contributing to rising inequality. Over the past 2 decades, incomes in Canada have increased nearly twice as fast for top earners, or for earners in the top 10%, as for those in the lowest 10%. The share of income of the top 1% is now the third highest amongst member countries of the OECD after the United States and the United Kingdom. And the last time inequality was this severe in the United States was in the 1920s. Moreover, labor's share of national income is now at its lowest level in half a century across most advanced economies, including Canada. We all need to recognize that the durable, high-paying manufacturing jobs of the future will be located in companies that invest to equip and train their workers and that are fully engaged in the global economy. And I'm going to switch to French for a moment. Une stratégie qui vise la création d'emplois de qualité doit aussi tenir compte de la transformation économique en cours de le monde. Il faut tout d'abord reconnaître les limites de la dépendance à l'égard de notre marché intérieur. Aussitôt après la crise, les politiques monétaires et budgétaires expansionnistes ont soutenu très efficacement une croissance robuste de la demande intérieure, surtout en ce qui a trait aux dépenses des ménages. Par exemple, après avoir reculé de presque 20% durant la récession, les ventes d'automobiles ont fortement remonté. Maintenant, elles dépassent de 4% le niveau d'avant la récession. Now, as effective as it has been, the limits of our growth model since the crisis are becoming clear. In particular, we cannot grow indefinitely by relying on Canadian households increasing their borrowing relative to their income. In the decade leading up to the recession, Canadians tapped their wealth and their homes to finance up to 1/5 of consumption growth. Housing activity is now near a record share of GDP, and there's increasing signs of overbuilding and overvaluations in segments of the real estate market. Now, in response, the federal government instituted 4 prudent and timely tightenings of mortgage insurance terms. OSFI, who's the bank regulator, has introduced tougher underwriting standards for home equity loans and enhanced their supervisory scrutiny. Our monetary policy at the Bank of Canada has remained focused on the inflation target, although under flexible inflation targeting, the Bank of Canada is prepared to support regulatory efforts if necessary, and consistent with price stability over the medium term to ensure sustainable and balanced growth. Even though it's desirable, eliminating the household sector's net financial deficit, so moving from a position where households are borrowing for consumption and investment, doing that will leave a noticeable gap in our economy. In fact, a $50 billion gap in our economy over 2 years. And this gap can only really be filled by additional exports and business investments. And the questions are investment for what purpose and exports to where. Thinking about the U.S., it's experiencing the slowest recovery since the Great Depression as a repair of bank, household, and government balance sheets slows growth. The only good news is that some progress is being made south of the border. U.S. banks have substantially increased their capital by about 25%, and American households have recovered more than 2/3 of the $16 trillion they lost in their net worth in the immediate aftermath of the crisis. Despite this, total debt in America has barely fallen from its peak of 250% of GDP, a level last seen in the Great Depression. This is because the U.S. government debt has increased $4 for every $1 reduction in household debt. We think that such treading water will persist for some time, since private domestic demand, so consumption and investment in the U.S. and housing, is still not sufficiently robust to outweigh an aggressive fiscal tightening south of the border. But the bottom line for Canada is that the American economy is not what it used to be. With less capital investment and more structural unemployment, the bank estimates that the U.S. economy will remain $1 trillion smaller than it would otherwise have been in 2015. Already, U.S. weakness means that Canadian exports are $30 billion lower than they would normally be at this stage in the cycle. Now, given our dependence on the American market, given that $30 billion figure, it's not totally surprising that exports are below their pre-recession peak. More broadly, with only 9% of our exports going to fast-growing emerging markets, our performance has been the second worst in the G20 over the past decade. And some blame this on the persistent strength of the Canadian dollar. And there's some truth in that, but in our view, it's not the most important reason. Over the past decade, our poor export performance has been explained 2/3 by market structure, who do we sell to, and about 1/3 by competitiveness. In terms of competitiveness, about 2/3 of that is the currency, is the level of the currency, and the rest is productivity. So on net, our strong currency explains about 20% of our poor export performance. It is something, without question, but it's not everything. So I'll say a couple words on recommended response, and then I will conclude, because you have a lot of work to do. To find and compete in new markets will require a concerted, multi-year effort of labor, firms, and government. First, we do need an aggressive emerging market-focused trade strategy. And that's why Canada is in a series of bilateral trade discussions with countries such as India and will participate in multilateral negotiations of the Trans-Pacific Partnership of Asian Nations. It's not just that emerging markets now account for 1/2 of all import growth, although that is incredibly important. 1/2 of the growth of imports comes from emerging markets. But it's also that they're essential to secure our positions at the higher end of global value chains. Secondly, as the CAW has long recognized, the quality of our workforce is one of our greatest strengths, and is one in which we must continually invest. With technology and trade transforming the workplace, the need to improve skills across the spectrum of work has never been greater. Both workers and management must continually improve in order to take full advantage of new technologies by making changes to design, marketing, and production processes. And thirdly, we need that open and resilient financial system that fulfills Ken's wish to, I quote, to not be at the mercy of global bankers who have learned nothing from the last crisis. More broadly, we need a system that provides sustainable, low-cost financing to businesses and consumers in the real economy so that they can grow output, jobs, and incomes. And I'll conclude en français. Le contexte mondial demeure difficile. Ces derniers mois, on a observé un ralentissement généralisé de l'activité dans les économies avancées et émergentes. L'Europe est retombée en récession et la crise qu'elle vit, bien que contenue, reste aiguë. L'économie américaine continue de croître modestement. Elle est restreinte par la réduction des leviers d'endettement encore et par l'incertitude considérable entourant le précipice budgétaire et la situation européenne. Les vents contraires extérieurs freinent l'activité économique au Canada. En outre, certains facteurs spéciaux à court terme pèsent sur la croissance. Le résultat est que l'économie progresse actuellement à peu près au même rythme que la production potentielle. Ce rythme devrait s'accélérer en 2013. On s'attend à ce que la consommation et les investissements des entreprises soient les principaux moteurs de cette croissance modérée, et ce, grâce aux conditions financières très expansionnistes au pays. Même si on prévoit un raffermissement des exportations canadiennes, celles-ci devraient se maintenir en deçà de leur sommet d'avant la récession jusqu'au début de 2014, et ce, compte tenu de la faiblesse de la demande étrangère et des défis qui subsistent sur le plan de la compétitivité, y compris la vigueur persistante du dollar canadien. Now, as the bank noted in its most recent rate announcement, to the extent that the economic expansion continues in Canada and current excess supply is gradually reduced, absorbed, some modest withdrawal of the present considerable monetary policy stimulus may become appropriate, consistent with achieving the 2% inflation target over the medium term. But the timing and degree of any such withdrawal will be weighed carefully against domestic and global economic developments. In a volatile global environment, we need to plan for the long term. We cannot devalue ourselves to prosperity or cut ourselves off from the world and hope to rely on ever-increasing borrowing by Canadian households. All of us, business, labor, governments, central banks, regulators, need to build on Canada's advantages. Our sound fiscal and monetary policy, a resilient financial sector, take advantage of those domestic inefficiencies that can be eliminated to boost employment and profit. Take advantage of those underexploited opportunities in the most dynamic economies in the world, and most importantly, our advantage of a highly trained, dedicated, and productive workforce, always eager to learn new skills. Finally, for its part, at the FSB, we will concentrate on designing and implementing the financial reforms that ensure that the financial system does its job to support the real economy so businesses can hire and invest, and the Canadian workers, including their leaders, can plan for the future with confidence. Thank you very much, and I'm happy to answer questions.
Thank you. That was a respectful appreciation and acknowledging you being here. Again, I'm going to take a couple questions. I see a couple folks at the mic. Mic one.
Mr. Carney, my name is Chris Buckley. I'm the president of CAW Local 222 in Oshawa and also the chairperson of the CAW GM Master Bargaining Committee. First of all, I want to thank you for taking the time to address the delegates at our convention this week. Our convention this week is a historic event. You might already know that on our agenda we will be discussing the creation of a new Canadian Union across our country, and I think it's historic as a result of you taking the time out of your schedule to address our delegates today, so thank you very much for doing so. We're being challenged like never before throughout manufacturing as a result of the Canadian dollar. Our Canadian dollar makes our current negotiations with GM, Ford, and Chrysler extremely difficult. Our real wages for Canadian auto workers relative to Canadian consumer prices are lower than that in the United States. But our dollar makes us look more expensive than we actually are. We are bending over backwards to try to make a stronger business case to invest in our Canadian plants. But our dollar makes it very tough and, in fact, painful. Our national trade deficit is bad, but the dollar remains high. We believe that has something to do with all that money pouring into Canada to take over our resource companies and our oil companies. I have one question for you, Mr. Carney. Do you agree that foreign takeovers have contributed to the strong dollar? Thank you.
Thank you.
You know what I think I'll do? I'll take, because we said we would take three questions because he's got to be at another appointment. Then he'll respond to all three questions at the end of the day. Mike 2.
Good morning, Mr. Carney. My name is Roland Kine, and I'm the proud and privileged president of CAW Local 112 in Toronto. Mr. Carney, I know you pay a lot of attention to the unemployment rate. I don't think the unemployment rate really tells the whole story of the problems in our labor market. There is a lot of hidden unemployment, people who've given up looking for a job. And then, of course, there's the whole problem of precarious work. People who have a job, but it's a totally insecure and irregular job. These workers don't know their hours. They can't plan their lives. They are badly exploited, and it's the weak labor market that allows employers to get away with it. Our union's economic paper estimates that true unemployment in Canada, counting these workers, is more than 2 million. Do you agree that the official unemployment rate does not accurately portray the problems in our labor market? And how are we going to put those 2 million Canadians back to work in a real job?
Mike 3, to have a little bit of diversity, we're going to go to Mike 5, and then that's it. Because, again, Mr. Carney has to leave for other appointments. Mike 5, so the other speakers will have to hold off or send the questions to him, and we'll get back to you if you don't mind later on. Mike 5.
Hi, thank you. I understand there's time constraints here. My name's Jenny from Local 3000. I have 3 questions for you, and if it's too long, you're welcome to email me later. I'll give you my email.
Good. Go right on. I'll just get my BlackBerry.
Okay. So I'm part of this group back in BC called Acorn Canada. I don't know if you've ever heard of it, but they've got some pretty big opinions on citizen wealth in society. And I just wanted to hear what you had to say about predatory lending for financial institutions. I also had the question, are there any plans to eliminate predatory lending practice from the banking system in Canada here? Also, Acorn believes that in order to generate citizen wealth, people need to have the ability to acquire real assets. The thought on this is that banks need to do fair and equitable lending standards by providing accessible lending service to lower and middle income families. And it's also believed that doing this will facilitate and increase social equity in Canadian society. And I would like to know what your thoughts on that are.
Okay, great. Well, these are outstanding questions. They're all fundamental questions. I won't be able to do them full justice in the time allotted. But as you said at the start, Ken, this is part of a dialogue, fundamental dialogue. And yes, do email in and let's continue it. But let me try to go directly to him on the issue of the currency. And I'm going to summarize the question as you did at the end, which is are foreign takeovers contributing to the strength of the currency. And let me say our view on the currency is a couple-fold. One, we don't target, as you know, and it's a matter of some debate, we don't target a specific level for the currency. What is influencing the level of the currency are our terms of trade, that is heavily influenced by the level of commodity prices, which have been well above historic averages for a long time, and we think that's something that's going to continue for some time because of the growth in emerging markets. So that's one element of that. The second thing is that Canada is viewed in a very volatile world, very uncertain world. Canada is viewed as a so-called safe haven. So we have flows into this country, not just of foreign direct investment takeovers, but portfolio flows. Capital is looking to come into Canada because of our strengths. And our challenge for those two elements is how to use them to our greatest advantage. Our challenge in the resource sector is how do we capture as much value added as possible here in Canada, because remember, historically, when resources prices were strong, the U.S. economy was strong. But resource prices are strong and the U.S. economy is weak. Resource prices are strong because of those emerging markets. That's one reason why we have to reorient, in our view, our economy towards those emerging markets. But the other thing is that from a value-added perspective, from a manufacturing perspective, from an input perspective, we need to try to capture more of that market share. I mean, we have 1 in 12 of the suppliers for the oil sands right now here in Ontario. We need to take steps to increase that. We have a huge disparity in terms of the price that's received for producers in Western Canada and the price paid for gasoline in Eastern Canada because we don't have the right infrastructure in Canada. It's something the Alberta Premier has recommended we look to change, and something we should do. So there's elements there. The second element, though, which gets more specifically to your question, if you accept, in general, that we're going to see capital coming into Canada because of our strengths, our challenge is how do we use that capital? And using that capital to build new productive assets, not importing to build McMansions or houses or necessarily on takeovers, but to build new productive assets that's going to build the export base for tomorrow. But I'm happy to continue that discussion. Secondly, on the official unemployment rate. Yeah, you're absolutely right, Roland. We do not just look at the unemployment rate. We look at a broad range, and everybody has to look at a broad range of measures. In the web version of the speech, we show what is called the employment ratio, what's the proportion of the population in Canada that is employed today. And it's not back. It's about 2 percentage points lower than where it was pre-recession, so it's a bigger dip. It's fallen off the map in the United States, which shows you that discouraged worker farmer phenomena. If you start adding up the categories that you mentioned, you'll get to an unemployment rate, a broadly measured rate of less than fully employed people who want to work in the neighborhood of around 11% in Canada. And that is about the level it was in 2002. And I said in my remarks that we know there's still, the economic term is slack, but the reality is there's still a lot of Canadian men and women who want to work more and want to work with more certainty. And that, to bring it back to what we do at the Bank of Canada, that is a big reason why interest rates are at 1%. It's a big reason. We have, for the non-crisis economies, so the countries that didn't have a financial crisis on their shores, within their borders, we have the lowest interest rates. And it's because there's slack in the labor market. So we look at that, and we'll continue to look at it, and it's one of the many reasons why we value this dialogue. The last question on predatory lending. There are a couple of things. One is, in terms of jurisdictions, the responsibility for this type of activity falls at the provincial level. That said, it is one of our least favorite activities, shall we say. It is exactly as you say. It is the effective interest rates that are charged are almost usurious, if not. I mean, officially under the legal definition, depending on the province, they're not, but they are effectively. And it's partly a question of financial education, but it's also a question of ensuring that the financial system as a whole is serving all elements of society. And while I didn't go into all the detail, the extent to which we take something which is called the, quote, shadow banking sector, which is rightfully named as something not necessarily always a force for good, and we convert that into a well-supervised, out in the open, more regulated, market-based finance sector, the more we do that, the more these pockets of